Well, joining us this morning to gauge where we are headed in the U.S. economy and the recovery, we are going to bring in Michael Moran. He is chief economist at Daiwa Securities America. It is the fitting host, or rather fitting to host him during a week that the FOMC meets. Mike himself was an economist at the Fed. Mike, glad to have you with us.
Thank you, Deidre.
So the Fed is meeting now. I'm sure they are deciding on what language they are going to use to deliver to the markets. What kind of tone? I mean, how can they strike the right balance that they need to strike for the markets?
Right. This is perhaps their toughest meeting in terms of sending a message, because they want to signal that they're going to continue to support the economy, but at the same time they have to start thinking about an exit strategy. When are they going to start taking away some of this massive stimulus that they have in place? So they've got to signal to the market that both they're supporting the economy and they're conscious and they recognize the long-run inflation risks that they're facing.
How do you think they're going to do that?
Well, I think they're going to continue to say, as they have at the past several meetings, that low interest rates will remain in place for some time to come. But when they talk about inflation, they're going to say something about long-term risks will not be ignored, that they understand that they have an unusually accommodative policy in place right now, and they will unwind that in a timely manner.
What about how much about quantitative easing do you think we are going to hear? I mean, are they going to continue to talk about the Treasury market, continue to talk about the MBS programs? I mean, how much data do you think we're going to get from on that front?
I don't think they're going to say a whole lot about that. They've announced that over the past several meetings. Everyone in the market is pretty clear on what they're doing with quantitative easing now. That is the amounts that they're going to be buying of Treasury securities and mortgage-backed securities. I think they'll keep those totals pretty much the same as they have been, or they've been targeting so far. They won't change those so much. And I don't think they'll talk about them very much either, because if they're not going to change them, there's not very much to say about them. They'll just reaffirm that they're in place and they're pursuing those.
What do you think of the predicament, I guess we could call it, that the Fed is in right now with the so-called bond vigilantes almost going against what the Fed is trying to do?
Right. Well, we have seen interest rates increase because market participants are concerned about a couple of things: the budget deficits that we're facing right now and the possible inflation risk down the road. But if you look at how interest rates have moved, I don't think they've been dramatic. They're up a good bit from where they were a couple of months ago, but if you compare them to historical norms, they're still very comfortable. They're still quite low by historical standards. I think it's also important to keep in mind that when we had the financial turmoil last fall and we had the very slow economy in the early part of this year, interest rates were unusually low. No one should have been expecting them to stay where they were earlier in the year. Once the economy started to show some signs of life, we're seeing that now, and interest rates naturally are going up closer to historical norms.
We've been talking about the two-year auction all morning with our markets editor, Andy Cinco, and he's saying from his read, it seems like there's going to be a lot of demand for the two-year, but the question remains more for the 5 and the 7-year. Are you in agreement with that?
I think the two-year will go well. It's a little early to say yet how the 5 and 7 will go. Partly it will depend on what exactly happens with the two-year today. They will all get done. It's just a question of what interest rates. You might have to see a little bit of a backup in the 5 and 7-year notes.
We also have some home sales data out today and tomorrow. How important is this going to be, do you think, for the Fed and for the statement?
Well, the housing market is among the most important areas to keep an eye on right now. We've been seeing some good signs, I think, signs of stability in the housing market. We're not seeing any sign of recovery yet, but at this point in the business cycle, stability is a good thing. That should be all that we're hoping for. We've been seeing that in the past several months. Housing sales have been moving basically sideways. I think you'll see a sideways move with the upcoming numbers too. And again, view that as good news, because it's a sign that we're starting to bottom out.
So it sounds like you do see indications of stability. Do you agree with a lot of economists that say we are going to see growth in the third quarter?
I have a small positive number for the third quarter of the year and a bigger positive number for the fourth quarter. About 1% in the third quarter, a little bit more than 2% in the fourth quarter of the year. We've got the private sector starting to turn. We're seeing adjustments made by both businesses and households. They're in a little bit better shape than they were previously. And we've got massive stimulus, both from Congress with fiscal policy and the Fed with monetary policy. That should turn things in the second half.
And one question that is on the forefront of many people's minds, particularly on Wall Street: when does unemployment stop rising?
That is the big one. That is very politically sensitive, very sensitive to the public. And unfortunately, that's going to lag a bit. It's going to be some time before the economy is strong enough to start bringing the unemployment rate down. We have to get above 2, close to 3% growth rate before unemployment starts to come down. And unfortunately, that's probably not going to happen until sometime next year.
All right. Mike Moran, thanks so much for joining us.
My pleasure, Deidre.
Mike, chief economist there at Daiwa Securities America.